Okay, think about this for a second. We're always told a strong economy means a strong currency, right? So why on earth would a country deliberately try to make its own money weaker? It sounds totally backwards, but it's a really powerful and, yeah, controversial strategy in global economics. So, let's pull back the curtain and figure this whole thing out.
Right off the bat, let's just put the question out there. Why would any government actively try to make the money in your pocket worth less? I mean, isn't that kind of the opposite of their job? Well, as we're about to see, there's a strange logic to it, and it's all about trade, competition, and frankly, survival on the world stage. And look, this isn't some dusty old economic theory. You've definitely heard about this in the news. Remember the US-China trade war? This accusation was front and center. The US would slap on tariffs, and China was accused of fighting back by weakening its currency, the yuan. And that whole situation, it's the perfect way for us to break this down.
Okay, so to really get what's going on here, we have to get our terms straight. There are a couple of key words that, once you understand them, unlock the whole strategy you hear about in the headlines.
First up, let's clear this up. You'll hear two words thrown around: depreciation and devaluation. Depreciation? That's when a currency gets weaker on its own, because of market stuff or a shaky economy. But devaluation? That's a deliberate, strategic choice a government makes. One is passive, the other is a very active move on the global chessboard. Big difference.
And what about that loaded term, manipulator? Here's the thing. It's less of a textbook economic definition and more of a political jab. There aren't any clear, globally agreed-upon rules for what counts. It's really just a label one country slaps on another when they feel the game is being played unfairly.
All right, let's get to the heart of it. The big question: why would you do this? Why weaken your own money? Well, it turns out that having a weaker currency can give your country a huge competitive advantage, especially when it comes to selling your stuff to the rest of the world.
Let's make this super simple. Let's say a toy factory in China sells a little toy for 7 yuan. And let's say the exchange rate is exactly 7 yuan for $1. For a buyer in America, that toy costs exactly $1. Easy enough?
Okay, now the US government adds a 30% tariff, and boom, just like that, our $1 toy now costs the American buyer $1.30. All of a sudden, it's not such a great deal. American shoppers might look for something cheaper, and that Chinese factory is going to see its sales drop.
So what can China do to fight back? Now here comes the clever part. They pull a lever. They weaken their currency. Let's say they shift the exchange rate so that $1 is now worth 8 yuan. The factory still gets its 7 yuan, but for the American buyer, that same toy now only costs 88 cents. It's almost like a magic trick that makes the price drop in another country.
Now let's run the final numbers. You take that new 88-cent price, and you still add the 30% tariff on top. The final cost, just $1.15. Now that's a lot closer to the original price. See what happened? The tariff is still there, but its power, its sting, has been seriously weakened. The toy is back in the game.
And it's not just about helping exporters. A weaker currency does something else. It makes foreign goods more expensive for your own citizens. This works like an invisible tariff, pushing people to buy stuff made at home. And here's another thing. If your government has a lot of debt in its own currency, well, this whole process can actually shrink the real value of what you owe. Pretty clever, right?
Okay, so we get the why a country would do this, but how do they, actually do it? It's not magic. There's a very specific playbook that central banks use. It really boils down to 3 main tools. First up, they can cut interest rates. If foreign investors get a lower return on their money, they're less likely to buy your currency, and its value goes down. Second, there's the classic move, just print more money, what they call quantitative easing. The more cash is floating around, the less each one is worth. And finally, they can just jump into the market and sell massive amounts of their own currency, flooding the supply and driving the price down.
So at this point, you're probably thinking what I'm thinking. Wait a minute, can you just do that? Isn't this basically cheating the system? Well, that is the billion-dollar question, and the history here is a lot messier than you might think. Because get this, it's not just other countries doing it. Back in 1985, the US itself was getting hammered by trade deficits, so it pushed other countries, especially Japan, into an agreement called the Plaza Accord. The whole point? To deliberately weaken the US dollar. And it worked. But it had absolutely devastating results for Japan. Their currency, the yen, got super strong. It choked their exports and helped blow up this huge stock and real estate bubble that popped in the most spectacular way, kicking off Japan's infamous lost decades. It's a huge warning about unintended consequences.
And that, right there, brings us to the flip side of this whole strategy. Because while these big moves might look brilliant from a national, bird's-eye view, they come with some very real and very painful cost for the actual people living in that country. It truly is a double-edged sword.
So who's left holding the bag? Well, it's the regular people. A weak currency means anything you import, gas for your car, food, electronics, all of it gets more expensive. That's inflation. And if your paycheck isn't going up as fast as prices are, you are losing ground. And on top of that, people who own assets like property see their net worth balloon, while people who just earn a wage get left behind. It just makes the wealth gap even wider.
And this right here, this is what we call the purchasing power squeeze. Just picture it. The bar for your salary growth is small, but the bar for the cost of living is huge. When inflation grows faster than your paycheck, you're effectively getting poorer, even if you got a raise. The money just doesn't go as far.
So let's just put it all on the table, side by side. On the one hand, for the country's strategy, you get cheaper exports and you protect your local businesses. But for the average citizen, you get higher prices, your money doesn't buy as much, and the gap between the rich and everyone else gets bigger.
So where do we land on this? Is it a cheat code for global trade, a really smart economic move, or is it just a desperate survival tactic in a cutthroat world? The honest answer is yeah, it's kind of all of the above. It really just depends on whether you're the one selling the products or the one buying the groceries.
At the end of the day, this whole thing forces us to ask a much bigger question. It's not really about strong versus weak money. It's about the incredible power that comes with controlling a country's currency. And it makes you ask, who really benefits from these decisions? And who always pays the price?